Wonderful. So good morning, afternoon and evening to all of you in all corners of the world. We are very excited to be hosting this webinar on a topic that's hotly debated nowadays in the insurance circles, more so in the agriculture field. The question being, can insurance be sold as a standalone product, or does it need to be bundled, and with what it can be bundled, and how? Is insurance the lead product and an additional service provided to it to make it more attractive? Or is insurance tagged on to some other product which makes that product a kind of a bestseller? Well, we'll look at a few of these questions today over the next hour or so in this webinar, which is brought to you as a part of the knowledge sharing activities with two large initiatives in agriculture insurance that we at the ILO's Impact Insurance Facility are a part of, the Index Insurance Forum of the World Bank Group's Global Index Insurance Facility, and secondly, the Global Action Network supported by USAID and the BASIS program of the University of California at Davis. Before we move any further, a quick familiarization tour of the system that we are using today. This is what you would be seeing on the screen, the list of our presenters, the participants, and etc. is available. What is important from a participant's perspective is the chat box on the right, where we request you to keep typing in your comments and your questions so that we can respond to them as we go along and answer your questions at the end of the webinar. You would also notice that the audience by default are muted, and this is in order for us to manage the noise and the confusion. But that certainly shouldn't stop you from asking your questions. You can tell us about it by typing in the chat box as I mentioned. And lastly, we have polls to get your opinion during the webinar. To participate in the poll, and you see the light here, you simply have to click your response and we will share the results as quickly as we close the polls. So without further ado, I'll introduce the galaxy of speakers that we have today. Similar to our participants, we've also been able to gather people from all across the world, right from the Pacific Coast, where Professor Michael Carter of the BASIS Research Program of the University of California in Davis joins us very early at 6 a.m. his time. To the other end, in Indonesia, where David Magui, the actuarial officer from ACRE Africa and now ACRE Asia, joins us from Indonesia. We have Shadrach Mafumo, the senior financial specialist at the World Bank Group, working extensively in index insurance and agriculture index insurance for quite some time now, joining us from Johannesburg. And we have Francis Javier Alboy, the Vice President of Planet Guarantee, an organization that's doing a lot of work in index insurance in Africa, joining us from Paris. I am Pranav Prasad with the ILO's Impact Insurance Facility, and together we hope to share some of the views and action that is happening in the field, as well as solicit your views and experiences across the room to make it a nice, sharing, interactive webinar. As we move further, before we get into the webinar per se, as I've seen from the list of the registrants that we have, a lot of us are practitioners, but we just want to check with all of you as to how many of you in your operations have done bundling of services. It may not only be in agriculture, but even in other insurance services that you have been offering. Have you been doing bundling? Just a quick look at that. So we have our first audience poll question, that do you as practitioners bundle insurance with other services? It's a simple yes or no. The poll is now open. Please answer as quickly as possible, and we'll be sharing the results shortly after that. Okay, so we are getting a fairly good response as far as the I votes are concerned. We'll keep it open for 10 more seconds. Last chance to vote. Okay, can we please close the poll now? And can we have the results too? Wonderful. So 2/3 of our participants have already done some bundling, and 1/3 are keen to learn more about it. So with this background, that a lot of us understand the issues around bundling and how it can be done and the challenges around that, let's move into the webinar. Can we please remove the poll now, and we can move forward into the webinar. So there are various aspects of bundling that people have been discussing and talking about. Just a quick look at the global perspectives around that. People say it works very well when you bundle insurance with credit. It works very well when you bundle it with farm inputs. Or the other side of the story says that if you bundle farm inputs with insurance, it works well. It can also be used as an incentive for purchase. Also, to improve stickiness to insurance, value-added services have been bundled across in various parts of the world. There's also been a growing trend over the last couple of years in giving insurance as an incentive. Mobile phone service providers have given out insurance to improve stickiness to their service, as well as insurance has been given as an incentive for accounts opening. You would have heard the large program that the new government in India has launched, where it's using insurance as a financial inclusion tool by giving it with every bank account that is being opened. So there are pros and cons to everything, and that's what we would like to discuss about. And does bundling have an impact at all? To share his experience of what has been seen in few of the projects that they are a part of, I'd request Michael Carter to share his views on how it works, what it works, and lead us into the webinar itself. Over to you, Michael.
You have been muted. Your microphone has been turned on.
Okay. Well, good morning, good afternoon, good evening to everyone. So I'm going to talk a little bit about the logic and some evidence on how bundling insurance with credit works in the agricultural context. So I thought first I'd say just a little bit about what I see as the logic of bundling insurance. If we think of insurance by itself, or agricultural insurance in particular by itself, insurance offers the insured person a certain kind of trade-off. It says, well, we'll protect you in bad years. We'll make sure your income doesn't fall so far. And in return, on average, your income is going to go down at least a little bit. So for a small-scale farmer, that may mean, you know, a 2, 3, 4, 5% reduction in average income, depending on how expensive the is. But in return for that small reduction because of the cost of insurance, the farmer in return receives a guarantee or an assurance that when things are bad, his or her income is protected. I'm an economist, and when economists think about problems like that, we say, well, risk-averse people will be quite happy to make this trade-off of reduction in average income in response for an increase in income in bad states of the world, such as a drought. Now, while people in the abstract might be willing to make that trade-off, that's actually a pretty severe trade-off for someone who's living on a low income level to actually contemplate. This problem itself is actually made worse when we think about index insurance, which tends to be the kind of insurance made available for small-scale farmers, because index insurance itself is imperfect, meaning there's some probability that the insurance contract itself will fail in those bad states of the world. And if the insurance contract fails to make a payment, even though the individual farmer has had a bad year, then the farmer has actually been made worse off by that insurance. As Daniel Clark at the World Bank likes to put it, the worst thing that can happen to the farmer has suddenly been made worse, because without insurance, the farmer might only fall income by 50%, but if he's also paid the insurance premium, and in those rare cases when the index insurance contract fails, his income is even lower. So this is a serious trade-off that I think we need to think about. So one way to consider making that trade-off less severe is to ask if insurance can be bundled together with what I've called here on this slide the expansion of economic opportunity. So we're going to look at a concrete example of that in just a moment in a project that I was involved with. It was also involved Planet Guarantee and the Allianz Insurance Company in West Africa. And in that particular example, we had farmers who were offered insurance, and at the same time, they responded to the availability of insurance by increasing their investment quite substantially in their main cash-generating activity. So for these farmers, the fact that insurance was along and promised them protection actually led to a behavioral change, which led to a quite significant increase in their expected income. And so in those kinds of circumstances where insurance is bundled with an ability to expand your economic prospects, then you begin to get rid of this trade-off between saying, well, you can have reduced variability, but you're going to have slightly lower income, because if you can expand economic opportunity simultaneously, you can perhaps have more stable income, but also higher income. So that, to me, is the core logic of bundling, or what I sometimes call interlinking credit and insurance. So let's just think about this just, excuse me, just a tiny bit more. So in the context of interlinking insurance or bundling insurance with credit, it's simply an insurance contract in which the lender is the first name beneficiary of the contract. So if the insurance pays off, then that money is issued, and some of it is used to retire the debt obligation, which the farmer used to expand his economic opportunity, such as the farmers in Mali who borrowed additional money to plant more cotton when they had insurance. Now, this kind of bundling or interlinkage actually makes most sense in environments where loans are under-collateralized, as we find to be the case, say, in Mali or many parts of the world. When loans are under-collateralized, this happens when farmers don't have mortgageable land rights, for example, then the lender is actually bearing a lot of the risk of default. And when the lender is bearing the risk of default, then the lender will tend to react to that by actually increasing the interest rate to cover some of that cost of default. If you're talking about a micro or a meso lender, which may not have a very well diversified loan portfolio, that sort of interest rate increase, which results from the lender bearing risk, can actually be quite substantial. So in those kinds of environments, bundling can make a lot of sense, because then the lender is no longer under pressure to increase interest rates so much, and so that the return from insurance can benefit the farmer directly through an increased interest rate. And again, I think this kind of arrangement in which lenders bear risk happens a lot in different kinds of value chain finance in agriculture. In value chain finance, it's typically the standing crop that serves at least as partial collateral for the loan. So this is an important kind of environment, I think, in many parts of the world. I want to contrast that with, say, places in Latin America where land rights are individually titled, loans are fully collateralized by a mortgage on the land. And in that kind of environment, the lender actually is bearing relatively little risk, whereas the farmer, him or herself, is bearing most of the risk. Because if things go bad, then the farmer will tend to lose the collateral. So let's just take a real quick look at bundling. So these beautiful little topographical pictures, if you will, come from a paper that's coming out here very soon in the Journal of Development Economics on bundling or interlinkage of insurance. These pictures are showing the height of the surface that you see in front of you. The height of that surface represents the increase in the uptake of a profitable technology by farmers, which is induced in the presence of insurance. The surface itself is defined in one direction. It's by the risk. So to our left, risk is not very severe, and to our right, or heading to the southeast, risk is more severe. And then heading in the other direction is the degree to which that risk can be successfully covered by an index insurance contract. So the southeast corner of that diagram is one where risk is most severe and best covered by index insurance. The west, I should say, the eastern corner of that space is where index insurance is both needed and works well. The eastern corner of the space, where the little mountain or the little surface is very flat, is an area where risk is neither high nor is it very well covered by index insurance. And what the two diagrams are showing then is the result of an economic analysis that says, what will the impact of index insurance be? Again, this is just a conceptual or a theoretical exercise. We'll look at real evidence in just a moment. And what we're seeing is that and these are both for low collateral environments like a value chain finance. And when insurance is offered as a standalone product, its impact on family well-being and livelihood through the increased adoption of a new technology, the impacts are really very, very small. Whereas if you have an interlinked insurance contract in these environments, we can see that in that eastern corner of the space, you would expect index insurance to have a very large impact on the increased adoption of a new technology by farmers. So it really is effective in the sense of crowding in investment. Now, this model assumes that the loan market itself is competitive, and that when loan contracts are interlinked with insurance, there's an interest rebate that occurs to farmers, and that's part of what makes this thing work from the perspective of farmers. But I think it's also important to note that interlinked insurance will actually have zero impact in certain kinds of environments. I suspect all of us get very excited about insurance. That's why we're here. But I think it's always useful to remind ourselves it's not the solution to the problem everywhere. The other point here is that if if you actually required standalone insurance as a condition of a loan, or if the lender requires insurance but there's no interest rate rebate, then in an environment where loans are fairly heavily collateralized, then requiring that insurance may actually have perverse consequences. And that's an issue that's talked about in this forthcoming paper if anyone wants to dive into that. And there's indeed a little bit of empirical evidence that happens. So we could talk more about that. But let's now talk about the real world as opposed to the theoretical world. So economists tend not to believe something in practice if they can't prove it to themselves in theory. But in this case, we had a randomized controlled trial of an insurance contract in Mali during the 2011-2012 crop year. And excuse me, sorry, I'm losing my voice here early in the morning. And this was an area yield kind of contract. We worked very hard to make sure the contract had a very low failure rate. And we offered this contract was part of the value chain. And cotton cooperatives, which are village-level institutions in Mali, were offered the opportunity to buy the insurance along with their loan contract. So it simply was like another input, where they might receive a loan that would cover insurance, along with the loan that would cover the fertilizer or the seeds that they were, which they were purchasing. So we ran this trial to sort of see what would happen, and the big question for us is, would farmers respond positively? Would their behavior change when they had this option to buy insurance? And roughly 30 to 40% of the farmers did actually purchase the insurance. And what we found was actually was quite stunning. We found that indeed, from the results of this randomized controlled trial, that the purchase of insurance led farmers to change their behavior in ways that would have suggested an increase in their income on average of about 25 to 35%. So these figures just show some quick results of the impacts. They're actually sort of like the diagrams we show. The bottom row of this table shows, for example, that the control group was planting about 2.5 hectares of cotton on average. The insured group here, and that's the second column in this table, what we're seeing is the increase over the 2.5 hectares. So the insured farmers were increasing their planting by around 40%, a little bit more than that even. And then you see the corresponding results that happened in the season. Cotton production went up, the amount borrowed went up, the fertilizer expenditures went up. And interestingly, the area that these farmers planted in other crops went down slightly, although very insignificantly. So we see a picture here where exactly that in index insurance, if it's a quality index insurance contract, can actually crowd in increased investment, meaning that farmers are not only getting the protection of insurance, but are actually going to anticipate higher incomes on average. So we don't have that trade-off between reduction in average income, but reduction in income variability. So just a final couple of words of caution. For any of this to make sense, for farmers to actually change their behavior at planting time in anticipation of insurance protection come harvest time, obviously farmers have to know that they're insured, and they have to have confidence in the insurance. Often we like, another question I'm sure we could debate for a long time would have to do with mandatory insurance. Mandatory insurance may make some sense, but one of the dangers of mandatory insurance is that farmers don't actually know they're insured. So we did a study of a mandatory insurance program in Ecuador where anyone making an agricultural loan had to be insured. Turns out a very large number of farmers didn't even know they were buying insurance. And obviously in that circumstance, it's not going to change their behavior. Similarly, if we think about meso insurance for lenders, meaning the lender simply uses an insurance contract to insure a loan portfolio, that may solve a problem for the lender, but unless there's some information passed to the farmer so that the farmer realizes that in drought situations his loan liability will be covered by the insurance, then there may be no behavioral problem. So again, I think we need, if we're going to think about what I call here a development objective of increasing small farmer income, we need to have this in mind as we design insurance contract. And finally, while I think the Mali project has worked well, the project, by the way, was cut off by a military coup in 2012. So that's the end of that particular story. But we had tried a similar venture in Peru several years earlier, and there we had real problems of uptake. So it's again, there are a lot of issues of trust and understanding that I think we are all very familiar with. So I wanted to share those ideas with you. I see lots of things chatting. So Pranav, I'll pass it back over to you, and I'll get a drink of water and try to restore my voice.
Thank you, Michael. That seemed very interesting. And Michael, if you're still there, we just have a small clarificatory question if you haven't really gone off for your drink of water. It's about the first. Michael, are you there?
Yes, I'm here.
Okay. Just a quick clarificatory question on the earlier slide. as to how much did the insured farmers earn more as the net income developed.
Yeah. Okay, so if we look at these numbers, what we can see is there was quite a large increase in planting, and the increase in cotton production here is about that's about a third of that's about a 33% increase over the income level. I'm not remembering. We put those figures together. In terms of cash income for these households, cotton is probably about 60%, I believe, on average of their income. So this would be about a 33% increase in sort of, or no, it's less than that. It's about it's roughly 2/3 of that. So it's about a 15 or 20% increase in family income from the insurance.
Okay, we've got the ballpark figures. We can come back to it in more detail when we do the question and answer. Thank you, Michael. So I'll just kind of link it up here of offering insurance bundled with credit and talk about it as a scale issue and help in building scale up around index insurance. The agriculture insurance programs in India are both heavily linked to credit, and it's mandatorily bundled with agriculture loans from nationalized banks for listed crops. This actually helped in increasing the index insurance program from an initial offtake of 250 farmers to over 25 million farmers today. An interesting thing about this program was that it was an initiative taken in the private sector by the private sector insurance companies, which actually demonstrated some positive impacts, and then the government took it on to bundle it with all the loans that they were giving out. So it's kind of a private sector program which government support helped mainstream. However, credit is perhaps not the only way in which this can be linked. And we'll request an interesting example from Africa to be shared. David Mugai will like to share what has happened with Acre in Africa, the Kilimo Salama project, and how it's used input providers to bundle the insurance. So over to you, David. All yours. David? David, please go ahead.
Okay, good morning, good afternoon, and good evening, guys. So I'll talk a bit about ECA Africa's experience in bundling in East Africa and the other areas that you're looking at. So ECA Africa is one of the pioneers in developing index insurance for agriculture in East Africa. So it started out as a project between the Syngenta Foundation and one of the local insurance companies. It was a project called Kilimo Salama. So over the years, it evolved to become a for-profit business venture. So ECA Africa, from the diagram, it's a service provider, and it looks to link the entire insurance value chain. That is from the farmer through the farm aggregators. ECA Africa is the intermediary with the local insurance companies and the reinsurance companies. So the major role of ECA Africa is product development, that is design, pricing of the index insurance. Then there's stakeholder coordination, technical support for
David, you're
the
fading in and coming
entire
out. Can you just be
insurance
slightly
value
louder?
chain,
Yeah.
risk monitoring. That is when we kickstart an index, we need to monitor it frequently to see that what the index is telling us is also what is going on the ground. And finally, there is product development. So maybe we can move on to the next slide. So how index insurance works particularly for product bundling is we have a farmer aggregator. So we have two types of farmer aggregators. They are the financial services providers. These are the commercial banks, the microfinance institutions, and the SACCOs, which are the saving and credit and cooperative societies. So these aggregators have a direct interest in the farmers because they advance the credit to the farmers. And if and when the farmers fail, when the farmers have a bad season, they have problems trying to collect the loans. Then the other type of aggregator that we have is the non-financial services. So these are examples are farmer groups. So farmer groups are organizations where the farmers come together, they make decisions on when to plant, what to plant, they when to harvest, who to sell to. So this is an example of a farmer aggregator who doesn't have a direct, who is not cash credit linked to the farmer. Then we also have seed companies as aggregators. So we have seed companies with a regional presence, and they would like to front insurance to as a value add to their customers. So they act as an aggregator for all their customers. Then you have agrochemical companies. These are companies which sell planting fertilizer, planting chemicals, pesticides, herbicides, and the rest. And finally, we have social enterprises. So social enterprises, so far in our model, has been the most successful in product bundling. So how the social enterprises work is they're the guys who start off with the farmers before they plant. They work with the farmer until they plant, and they also work with the farmer after harvesting. So the social enterprises have a kind of a closed loop business model. So they advance the farmers the inputs, they offer them extension services across the entire season, and at the end of the season, they purchase the produce from the farmers. So the type of bundling that is involved at this point is it's input linked. So once the farmer is advanced inputs of some particular value, then the aggregator, the social enterprise, takes insurance on behalf of the farmer. So for all these aggregators, it's key to understand that the aggregator takes the insurance on behalf of the farmer, but the beneficiary is the farmer. So the role of ACA, as earlier discussed, is to link the entire value chain. That is, you want to link the smallholder, the individual farmer, to insurance via an aggregator, and also you want to link the local insurance companies to the international reinsurance companies. So there are many models to get to many models to get to the masses. ECA has leveraged on technological implementation. So one of the biggest advantages of going with the aggregators is that we leverage on the existing farmers and we leverage on their existing distribution channels. So, for example, a seed company, when we partner with a seed company who has a regional presence, we distribute the insurance via the already existing distribution channels from the aggregator. If it's a farmer group, we leverage on the farmers that are already in the farmer group. And the other thing is technological implementation. So I'll talk about that in the next slide. So the role of the aggregators is the role of the aggregators. Sorry. Is to advance the credit, is to advance the inputs, and they're insured on behalf of the farmers. So we usually, if an aggregator has about, let's say, a figure of 20,000 farmers, we do not go speaking to each and every farmer trying to sell insurance to them. So we train a few key personnel from the aggregator, and then the aggregator is tasked to educate the farmers on insurance. So the aggregators usually take different approaches to avoid moral hazard. There are some aggregators who do not necessarily inform their farmers that they are insured. This is to reduce moral hazard. And there are some aggregators who educate all their farmers. So farmer education on insurance, we leave it to the aggregator if he's comfortable to educate his farmer, or if he isn't comfortable to educate his farmers. Then can go on to the next slide. So initially, when ECA Africa started as a project, we used to target individual farmers. So we came across many challenges. Those were our initial models, were targeting individual farmers through extension workers, through a big, massive ground force sales force. So we came across a lot of challenges, and one of them, and being the biggest one, was administrative costs. So most of the farmers in East Africa are smallholder farmers. So we would have scenarios where our administration costs, our costs of getting the farmer, were about 400 times as much as what he's paying in premium terms. Then the cost to the farmer was also a challenge, and financial literacy to the farmer. So administration costs, cost of premium to the farmer, and financial literacy are our biggest challenges to the individual farmer. So this led us to think of innovative ways in which we could try and get more farmers. So this is where we shifted our focus more onto bundling our index insurance product with either the credit linked or input linked aggregators. Another challenge that we had was the weather data. This is the rainfall data. So one of the ways that we came around this challenge, in East Africa, there wasn't an expansive network of rain gauges, and we needed to scale up. So once we overcame the cost to farmer, administrative cost, and financial literacy, by going through an aggregator. There were some other challenges which are outstanding, the weather data being the biggest. So we had a six-month project where we analyzed the rain gauge data against the satellite data. Satellite data is provided by NASA. So for expansion, for regional expansion, we leveraged on satellite data to increase our presence. Then there was triggers and design. Triggers and design, this is the particulars of the index. So we also, once you have an aggregator, a large aggregator, you'll have, let's say, again, for example, 20,000 farmers with each planting on a different date and each planting a different crop. So this was another challenge that we experienced in bundling. So we had to increase our capacity to design indices and triggers. Then there is also a basis risk. So in index insurance, this is, I think, one of the biggest challenges. So one way that the bundling of insurance helps reduce basis risk is that I'll give an example of 1 year in 2012 where one of the big aggregators had a claim, and some of the stations.
David, can we move on to the actual example? You've outlined very well the role that aggregators can play. Thanks.
There was some losses on the ground. So the aggregator knows which particular farmers had a loss and which particular farmers didn't have a loss. So one way of managing this basis risk, one was we had the constant monitoring of the indices, as earlier indicated. So the client was well aware beforehand, and the other one, being an aggregator to the farmer, once the aggregator received the payout, they were able to redistribute it amongst the farmers who are highly affected, medium level affected, and the farmers who are not affected. So that was one way to get around the basis risk. The other challenge, yeah? Pranav? Okay, so...
David, we've lost you.
I'll give an example of one of our products where we leverage on the satellite data, we leverage on the aggregator, we leverage on...
David, we've lost you.
Mobile phone technology. So this is a very simple product called the replanting guarantee. So the start of the season is usually a gamble for most of the farmers.
David, technology doesn't seem to be on our side today. Perhaps we can come back to you as we move forward. Huh?
So this product was born of an actual problem that we had in the field. Initially, we had an entire crop season cover, but in that particular year, the crop failed in the first 3 weeks, and we, as per the contract terms at that point, we could only pay at the end of the season. So this product was born from that necessity. So how the product works is you place the insurance in a seed bag. So once the farmer purchases the seed bag, when he's at the field, when he opens the seed bag, there is a card, and the card has some instructions on
Hello, David, I think we've lost you and we'll back to you in it. Interestingly, there are some nice growth figures. Bundling led to the growth, and we can see the figures here in the slide of how the number of farmers insured grew from 185 in 2009 to 233,000 in 2014, as well as the sum assured also going up. I'm sure we'll kind of come back to
How
David
to register
in
in the
some time when
insurance
technology.
scheme?
David, 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 it seems to be
Yeah,
coming back,
I'm
so
around.
I think we'll try and do something at the back. Yeah, I know you're around, but we seem to have lost you and you've come back. In any case, I have told the audience about the figures and the wonderful sales that have grown from 185 to 233,000. So I guess we'll move on and come back to you once the speakers have spoken so that you can respond to any of the queries that the people may have. By then, we'll try and do some technology work on the back end also. I hope that's okay with you.
Okay. Okay, sure. That's fine with me.
Yeah, thanks. Thanks. Okay, so we've heard David giving us some views on the various channels that can be used for bundling and how the savings and cooperatives have acted and the various issues around farmer groups to social enterprises too. We heard examples of Indian mandatory stuff as well as voluntary examples being done. So we'd at this stage do a quick poll from the audience and try and get their views on when can bundling be an effective mechanism for scaling up, when it's mandatory or voluntary. So can we have the poll now and responses from you on when can insurance work best as a mandatory product or a voluntary product? This has to be a quick poll since we are slightly behind. Okay, 2, 1, 0. Can we close the poll now and broadcast the results? Okay, so the House is fairly equally divided between 57% and 43% of mandatory versus voluntary. So it's great that we feel that both aspects can work. So let's quickly move into an interesting new example of what Planet Guarantee is doing by combining different kinds of insurances into the same product and seeing how it goes. So over to FX Albury, the Vice President of Planet Guarantee. Over to you, FX, for your perspectives. Please go ahead. Please go ahead.
Hello. Yeah, thank you. Do you hear me? Hello. Yeah. Okay. So thank you for all this, all the meetings here. It's very interesting, and thank you, Mike, for mentioning what he did with him in Mali with Planet Guarantee. As you explained, Planet Guarantee is an operator in microinsurance, active in Western Africa and also in Latin America. What we have to say concerning bundled products is that all crop index insurance policies we underwrite are bundled products because they are linked to credit, to entrance credit, in order to avoid exactly in order to get what was the explanation from Michael and to permit to the producer to enlarge his projection and credit being insured. What we know is that in emerging countries, I'm going to go a little bit fast because I know that we are late. In emerging countries, bundled products have quite different aims than in developed countries. Here we have the main aim, the principal aim, I think, is to protect the income of the producers, and especially when they belong to vulnerable population. And the second aim is to optimize our contact with the clients, because as distribution network are poor and communication network are elusive and poor, we have to optimize the contact with the clients. And it's really different from the marketing approach in OECD countries, where the idea is mainly to increase customer retention. So bundled product in the context of microinsurance has to be invented and designed and help with the help of economic analysis as Michael mentioned it. Could you switch on to the slide? Next slide, please. Hello? No, previous slide. Yeah. Price of, no, previous. Sorry. Well, in the context of emerging countries, what we know is that the income of households and of rural population are highly affected by climatic conditions. That's the previous slide, I guess. Yes, that's correct. By climatic conditions, which affect yield and prices. They are also affected by health condition and situation of the producer and its family, and more generally its community. And they are at last affected by the volatility in price of crop prices. And in our research and development, what we aim to do is to try to protect population against these three kind of risk. And we are doing it with index crop insurance against climatic risk. We are going to start it and to bundle climatic index crop insurance with healthcare insurance, which will start that next year in Mali and in Senegal. And we have not yet a solution, but we are trying to identify a solution in order to protect population against volatility in prices. Besides, we may mention that purchasing power in healthcare is also very sensitive to income, and protecting healthcare schemes via index insurance, it seems to us something feasible. Next, next slide. Yeah, that story of volatility in price is very impressive. For instance, in Mali and in Burkina Faso, we recorded 2 years ago a 20% drop in prices of maize when we were protecting people against climatic risk, which is around 7 to 10% of the capital involved. So you see that the volatility in price affects the income of population twice as the climatic risk. And here we observe that the medium term, the medium trend is positive in numerous of speculation in coffee, for instance, or in cocoa, but even if the yearly volatility is very high. And we should think, but it's a research matter, and there is a lot of researcher in the assessment, we should try to identify financial products that should be designed to protect the vulnerable population against volatility in price. As already all the big agro-industry operators, as a matter of fact, are already protected against those risks. The next slide will show you the map of the volatility, which is very impressive. Huh? The vertical axis is going from a scale of 200 up to 800, and it's an index in price of coffee. And the horizontal axis is going from the 80s up to now. You see that the price of coffee is facing a very high volatility, and that affects highly the producers. And I think that as a micro insurance operator, we should address that question. Even at this stage, we are unable to offer proper solution. Remember maybe that maybe 20 or 30 years ago, those populations were protected against volatility due to what they call the stabilization funds. And all those caisses de stabilization, the caisses de stabilization in Africa, in Western Africa, they have been abandoned because they were contradicting with the public finance equilibrium. But maybe it was a good thing to end with caisse de stabilization. Nevertheless, the population are no more longer protected against volatility in price, which are very, very important and sometimes more impressive than climatic risk. Concerning what we are, the next slide. Health and climate is also a topic for reflection and research. As I already mentioned, in practice, healthcare expenses also population are linked with the yearly income and especially in rural areas with the yearly crop prices. And protecting health insurance scheme with basic index insurance should be in principle feasible, and we are planning to do it in Côte d'Ivoire again next year. Maybe the next slide, please. Thank you. So these are very short example of what we are going, what we launched this year. Finito is a bundled product with a saving account, a saving contract, plus a death and disability insurance, plus an health insurance focused on highly severe pregnancy risk. And you see the detail of that contract. And there is also, in a certain sense, to be attractive, a lottery, which delivers you 1 million French CFA with 3 months, it's a 3-month lottery game. And so we have a saving account, plus a classic disability and death insurance, plus that health insurance focused on very severe pregnancy risk like eclampsies or well, very severe risk, and plus a lottery. And it has been distributed, it is already distributed with a mobile phone operator, Orange Money in Mali, and it has been proved to be quite successful and well accepted by the population. As you see, the entrance is very okay. What we are going to launch also is we are designing a product, an healthcare insurance product, which will be especially for rural areas. And we have in certain regions, and especially in the Moronou in Côte d'Ivoire, we have identified a network of healthcare providers with whom we are contracting out, and we are going to link to bundle the product with a crop index insurance in the same time. And the premium will be in Western Africa, France, 60,000 for a family, a small family, a nuclear family, and which stands for roughly $100 per year for 4 person. And you may add as many children and members you want to add in the contract, obviously. Next slide. Maybe it's not exactly our topic today, but as David previously mentioned, the whole aggregator is very is key and essential in the managing of bundled products. First, because it has been outlined by Michael, it reduces collateral risk, and also because it's a good way to have one contact point with the client, and so we develop portfolio products and bundling approach with various banking and cooperative aggregators in Western Africa.
Okay.
So our feeling, okay?
Wonderful. Thanks, FX, and we got a very good view of how various things between climate and other things can actually be involved and linked in. And as we move along, I'd just quickly mention another program that we've just experienced, which is with Sanasa Insurance Company in Sri Lanka, where weather-based index insurance has been bundled with a personal accident cover and a hospitalization cover, which has helped improve the customer's understanding about insurance per se and has got more people to buy the weather index insurance product. So it's not just insurance with other services, but insurance with other insurance products that has worked well. The other interesting example we've had are in India and Zambia, where weather forecasts and agriculture advisory services have been bundled with index insurance to improve the trust on the product and to improve stickiness of the product and shown improved renewals. All of these products have actually been tried out with various degrees of success in various places. And to bring it all together and to share some other examples, I'll hand it over to Shadrach Mafumo of the Global Index Insurance Facility of the World Bank Group. Shadrach just has a very difficult task to go through his slides quickly and give us a perspective of what is happening so that we can then move on to the question and answer sessions. So over to you, Shadrach, for a quick session.
Okay, thank you, Pranav. Yes, I can see that I've got very little time, but the way I've decided to, I think, make sure that we can get the best out of this is to give a subtitle to my presentation. So the subtitle is 3 takeaways and suggestions. So as you are looking at the first slide, so the first slide is what I'm suggesting here is if you are thinking of bundling index insurance with other services, the first thing that you have to do is you have to undertake a detailed study of other successful examples of bundling insurance with other services. And what we can see is the easy examples that come to mind. In most countries, we see that if you want to renew your annual road license, you are required to have a third-party car insurance. We know if you want to buy a house and you can't buy it for cash, you want a bank loan, they will ask you to have a property insurance. If you want a loan from a microfinance institution, they will ask you for a credit life insurance. We know of companies that have bundled. They also say, well, if you buy airtime, then you can get some funeral insurance, or you can get life or funeral insurance as a bonus. So looking at this, I think we can see that there are some examples of bundling that has happened, but which is not index. And then the key things that one has to ask themselves is, who are the key stakeholders that are in each of these in each of these insurance and services bundling? And the second is you look at what are the kind of partnerships that are required for such a bundling process to happen. And then you also look at the legal framework that is present or that you need to take advantage of. And so that was my first suggestion for you to undertake a detailed study of successful examples. And then the second suggestion is you need to consider the key drivers for bundling index insurance with other services. And in that case, what you need to look at, you need to understand the target market that you are looking at. So if you are looking at agribusinesses, I think as we have had on cases of Zambia and cases of where Microinsure was working with the NWK and Cargill, and in cases where Guy Carpenter was working with Sanam and Olam in Mozambique, you can tell that the agribusinesses there, what really drove them to bundle index insurance with their services was actually because they wanted to increase customer loyalty and to prevent side selling. And then when you look at the farmer, the driver for them really to be interested in getting index insurance bundled with their services is, first of all, is they want to get an increase in net income, which calls that I think for each one of us, before you think about selling the product to an index product to the client, you have to ask yourself, in the end, is the net income of the farmer going to increase? Because I think, as Professor Carter was saying, if your product is not going to be paying and the client has paid the premium, then the client is actually in a worse situation than they were going to be if they had not bought the insurance. So the idea is you have to make sure that you are offering the client a product that will protect their assets or increase their income and obviously their wealth in the end. And then for what is the driver for a financial institution? I have put there as improved risk matrix, but what I mean there is they want a low probability of default and high repayment rates. And when you look at that, I think you find a lot of banks, they want to see something quantitative, which is something that I'm going to be talking about at the end of my presentation. And the suggestion number 3, which is the next slide, is when you need to consider operational and practical considerations. I think more often we people talk about bundling, and if you look at the examples I have given, these are examples of motor insurance, credit life, and funeral insurance. The premium rates, they are 1%, 2%. When you're talking about index insurance, the premium rates, they are 10, 15, 8%. So what does that mean? So a key practical consideration that we have to take into account is because of high premiums, there is need for high investment in client education. The client has to understand that when you are talking about covariant risks like droughts, like typhoons and all that, the impact is much higher, and so the average cost of that is much higher than what happens with credit life, what happens with motor. So I think a practical consideration is, if you are considering that, know that as an institution you will need to invest a lot more in client education. The second is you also have to take into account the cost of bundling. At times you find that when you're trying to bundle the index insurance or another insurance product with the service, you may find that the cost of registration or the underwriting costs and the claims, they outweigh the benefits that the farmer or the financial institution would have. And if you would need to come up with a new system, that alone would actually tell you that the bundling exercise may actually end up being futile. And the third point, the third operational or practical consideration is the source of premium income. More often you find that people or designers of products, they normally think about, okay, what is the loan portfolio? For example, you can have a loan portfolio of a bank willing to offer a loan portfolio of 40 million. But if you have got index insurance being added at 10%, which means the total amount that is needed there is 44 million. The 40, which is the loan to the client, the 4 million, which is for the premium. So make sure that the premium income, when you are talking to the bank, that portion of the income will actually be covered. Otherwise, you still end up having sold the idea, but having a problem of liquidity. And the last point that I would want to highlight is more often we try to sell or when we are trying to bundle a product, our index insurance with the existing services, there's a tendency to raise a lot of qualitative arguments, And my experience has been, I think most banks or MFIs, or they're already tired with hearing people telling them that when you have got a drought, this insurance will reduce your loss by a certain amount. What they actually want is for you to take some quantitative metrics that you can show to them. I think Pranav, you can go to the next page because I can see we have 4 minutes left. So I just want to go. Yeah. So when you look at when you look at that, all I'm saying there is, if you look at the metrics on gross and NPL, what that is telling you that is that without insurance, there's a 60% probability that the next season the MFI will suffer more than 4% NPL. If you go to the net of insurance, it's actually showing you that insurance has been able to reduce the probability from 59 to 0%. And you can see that a 1 in 20 year event could be 9%. So in 1 in 20 years, you could have NPLs that are about 9%. But if you have got insurance, insurance is able to take away the risk and reduce a 1 in 20 year to be like 3%, which is below the 4% target that the bank would want. So I think those are the three suggestions or takeaway that I had. The first being you have to undertake a detailed study. The second was that you have to understand the key drivers. And the third was understand the operational and practical considerations and include some quantitative analysis to convince the partners. Thank you, and back to you, Pranav.
Thank you, Shadrach. Thanks for showing us all a mirror and telling us to keep to the practical side of things and the words of caution that you've brought it up. We've had some very interesting discussions on the chat box also on the side, and I think therefore this last poll for us makes a lot of sense. So a quick poll for the audience is that we've heard of various things. We've heard of loans and credit, we've heard of bundling with fertilizers, we've heard of voluntary value-added services and other insurance cover. So let's have a quick poll and trying to get the audience's views on what is the best suited. Of course, it depends upon circumstances, but what according to you is the most appropriate service that can be bundled with agriculture insurance and help it scale? So can we have the poll now, please, and your votes too? This is a quick poll, so please vote quickly. Let's give it another 5 seconds. We are closing the polls now. Can we please close the poll and broadcast the results? Okay, so more than 50% of us believe that loans and credit are the best mechanisms currently to help index insurance grow. Input providers also coming in strongly at 30%, and other value-added services coming in. Surprisingly, other insurance covers don't make a presence now. So I guess the ball is in Planet Guarantee's court and Sanasa's court to see how it works and tell us from their experiences as we go along. So wonderful. We've had a range of activities being talked of. Can we remove the poll, please? We've had a range of activities being talked of, from what index insurance means to be bundled with other services, what are the various channels with which it can be bundled, some practical considerations, and examples of combining different kind of insurance services. So before we go to the question and answers, and I'm afraid it's going to be a short one, but we will still take some questions, I would just want each one of our panelists to share some concluding thoughts on what they have as far as bundling of index insurance is concerned. So, Michael, from you on what index insurance can mean to be bundled with.
Right. So again, as I show here, pricing I think is a key issue, and I just wanted to remind us that from the farmer's perspective, price is not just the money price, but also the strike point that takes place. It may be hard for an individual to say, well, is this sort of strange product worth $25, but they have a much clearer idea if they say this product will only pay off when yields fall below a certain level, and farmers know in their own minds whether that level is high or low. And since those in agricultural insurance, those are sort of key parameters of the contract, we've actually found that farmers are much more sensitive to changes in those strike point levels than they are to changes in the money price.
Thanks. So it's all about pricing according to you. Yes, Shadrach, what do you have to say in one line? You've told us very practical views, but anything else you'd like to share?
Well, I think for long-term sustainability of bundling process, we need to make sure that it's a win-win for each and every stakeholder that is in the bundling process, which goes back to understanding the key drivers. So what is it there for each of the stakeholders that are in the bundling process? The farmer, the aggregator, the insurer, and everyone else.
Okay, wonderful. David, sorry you were cutting in and cutting out, but you can certainly have as a concluding thought on what you feel is the critical aspect for bundling for index insurance and agriculture insurance as a whole.
Okay, there are already existing avenues to get to the last farmer. There are existing distribution channels to get the last farmers. So instead of trying to create new channels for index insurance, let's deliver index insurance as a bundled product to the farmers. We use leveraging on existing mechanisms, and it will be a key strategy for scale up.
Okay, thanks, David. FX,
Yeah.
your take on bundling for index insurance pricing issues? Go for it, FX. Yes.
Well, from our side, in practice, the main obstacle to bundled product is affordability to pay from population, especially in countries where now the crop insurance is subsidized and neither health insurance is subsidized or is organized by the state. So we are very rapidly, we face a frontier which is the affordability to pay, and we have to cope with it.
Okay, thank you. Thanks, FX, and thank you everybody for these thoughts. So we've had a look at various aspects of bundling agriculture index insurance over the last 1 hour, and we've, as I mentioned, had extremely good discussions in the chat box also as we went along. I'm sorry though I said the timing for question and answers would be less, but we will not forget your questions. We've got a record of all these questions, and we will certainly get back to all of you with answers to your questions and to those that we are unable to take up in the question and answer sessions. But the panel is very keen to respond to some of the key questions that have been put up. And let's start with some of the questions that have been collected in the key box. We have a question for you, Michael, from Rachel Sparrow of the World Bank Group, where she's asking for any empirical evidence that we may have of interest rates being reduced when insurance has been bundled with credit. So any views on that, if you can shed some light on that?
Yes, actually. So I mentioned a cotton insurance product in Peru, which we had going, and there was about I believe it was about a 15% interest rate reduction, which was offered by the lender. There's a product just going to market now in the Dominican Republic, where again the lender is offering something in the range of a 10%, not 10 percentage point, but a 10% reduction in interest rates. So lenders, I think, for the reasons actually Shadrach showed very nicely, lenders are pretty aware in lots of situations that if they don't have insurance, they they have to charge higher rates to basically manage the risk internally. So I think that's a thing that can be discussed with financial institutions, and they very much I think they very much understand this issue.
Okay. I think, Shadrach, this question from Joel Gonzalez is more up your alley, which says, in order to expand index insurance in most low-income developing countries, is there any reliable mechanism to collect weather data in countries with insufficient or unreliable official sources? So what have your experiments through the Global Index Insurance Facility shown you? How can better data be collected?
Yeah, so collection of data is has actually been a challenge, but what we believe in the World Bank Group is the data is usually more of a public good, and you find that when you have got good data, you don't end up using it for index insurance only or for the insurance index industry only. It ends up being used for a lot of other purposes, like where we were saying you could actually use it just to give advisory services to farmers and all that. So we believe that data is something that data collection is something that both the private sector and the government should be working together. You know, like from the examples we saw with ECA, some of the data they've gone ahead as ECA themselves put some stations. We know, like in India, there are some private companies that have put in some stations themselves. We know satellite providers or companies that analyze data like IRI. So what the Global Index Insurance or the World Bank has been doing is really not inventing the wheel, but actually seeing who has strength in what as far as the collecting or analyzing data is concerned, and we've been trying to bring these specialists to work with us so that our clients can actually access that data.
Okay, thank you. David, there's a question coming your way from Lavesh Kumar Agrawal. He is actually wanting to understand very quickly top 2 or 3 challenges that you faced while implementing the Kilimo Salama pilots. How did you get these aggregators together and get them to explain to the farmers what the insurance was all about? Because they were at the end of the day selling seeds. So what was the biggest challenge that you faced?
Some of the 2 top challenges that we faced, one, Shadrach has just mentioned it, was the weather data. So obtaining rain gauge weather data was first of all expensive, and we were not able to get a good historical data set. So one way that we overcame with this challenge was to set up our own weather stations for some time. Then as demand for the product grew, we couldn't install as many weather stations, so we partnered with IRI, guys from Columbia University. So we had a lot of research around how satellite data can be correlated to the rain gauge data. And from then on, we expanded using the satellite data. So that was one way we tried to tackle that challenge. Then the other challenge was the distribution costs. So there was a time when the distribution cost was about 400 times more than the amount that we used to collect. So we changed tactics and were looking at aggregators more and more. So the seed companies, the value proposition to them was the loyalty thing that again Shadrach can talk to. So in that region, if your seed would fail and within the first few days of planting, then you would go to the same dealer. You'd get paid by the same seed company, and you'd get your seed back to pay. So the seed company saw this as a loyalty program and something to put them ahead of the market, and the other aggregators like the social enterprise, they saw the value in the insurance because their farmers would be able to advance loans again to their farmers the following season, since they would recoup a bit of their loans to the insurance payout. And in terms of educating the farmer, so we had a challenge going to each and every farmer. So we leveraged on the extension. Most of the aggregators have extension officers. So we would train 2 or 3 key people in the aggregator, and they would disseminate the information down to the individual farmer level. So we leveraged on the extension workers of the aggregators.
Okay, wonderful. Thanks for sharing these challenges, that it's not all smooth sailing when you implement these programs. So there's just one more interesting question. I guess it's for the panel as a whole, but perhaps Shadrach, you can take a first pass at it. Is from Armin Martisian. We've all been talking about index insurance and how it works, both yield and weather based, but can indemnity insurance be bundled with loans as well? Any examples that you have along these lines?
Okay, so I think a very good example that everyone may remember, which unfortunately I think because of other reasons it didn't continue operating, was the work which was supported by Mercy Corp and Micro in Haiti, where actually the product itself, yes, it had an index portion, but as far as what the farmer was getting, so the index was between the reinsurer and the insurance company, but between the insurance company and the people on the ground, there was actually an indemnity policy where there was an assessment. So when there's a typhoon or a hurricane, some local group members would go and make an assessment. So like the leaders of the society would go, make an assessment and report that and give the magnitude of the policies. I personally think that especially given that index does have some basis risk, there could be maybe a combination, a hybrid, whereby you do not go and see each and every farmer's field, but in cases where it has been reported that there is damage and your index did not trigger, you could then have a mechanism where you've got some already selected evaluators that could go and evaluate the village, not necessarily the person, but evaluate the village and make a payout on a village level, which could be sort of an indemnity, but which is like an area yield type of indemnity payment. But so I think in future, especially with technology and using smartphones and all that, I believe that we could end up having some reports to the insurance company of damage losses being given through technology, and indemnity or traditional ways of settling products being done. So technology, I think, will merge both index and traditional. That's what I think.
Okay, wonderful. Thank you. I'd just like to highlight the Haiti example also to a question that Gabby Ram asked on combining index insurance with disaster risk reduction measures. I think the same Haiti case was indexed to as Shadrach mentioned, the losses on the ground too, and disasters caused by hurricanes and typhoons. So there was some attempt at building these linkages of indexing the disaster risk losses as we went along, and also bundling with indemnity products. The entire National Agriculture Insurance Scheme, the way it was launched in India, combined actual losses on the ground of the farmers who had taken the loans, and it was compulsorily, insurance was compulsorily bundled with the loans that they had taken. So yes, indemnity insurance can be bundled with various examples. It's just that index insurance offers a more transparent way of doing things and a faster way of doing things, so therefore there's been more talk of index insurance as we went along. So great. I know there are lots of questions, but we are already over time and my tech team is pushing me on that. So like I mentioned, we've taken a note of all the questions you've been asking, and we will certainly get back to you with the answers and request the panelists to respond to them and get back to you shortly over the next 7 to 10 days. So please watch out for those, and thank you very much for all these questions you've asked. Just to close the webinar, I'd like to thank the panelists for all the inputs that they've provided, and all the participants for all the interactive questions and issues that have been raised during the webinar. It's a topic that's just kind of taking root, and we'll have lots of things to talk about as time goes along. And today we've been able to share some of the aspects of linking it with credit, of the various channels that can actually be effective, of various other products in which it can be combined, and some of the impacts and challenges that we have seen. I'm sure there's more to talk about, but we'd have to close the webinar right now after thanking all of you and thanking both the Index Insurance Forum of the World Bank's Global Index Insurance Facility, as well as the Global Action Network of supported by the USAID and the BASIS program of the University of California at Davis, for this opportunity to share these programs and share these lessons and interesting aspects with everybody. So please do keep writing in, and feel free to get back for any of the other issues that you may have. And we look forward to catching up with you in the next webinar. Please keep your, should I say, internet open. We'll be announcing it as we go along. Thank you very much.
Thank you.
Thank you. Bye-bye.
Thank you, everyone.